out. My contact info is going to be on the last slide as well, and I'm sure you guys all have it. So please keep that in mind. Moving on. Okay, always with all my presentations, I do kind of a quick current market update, just so you guys know what's going on. You guys should get these questions quite a bit from your clients, interest rates, what's going on in the, big macro style economy. These are important things for you to know. And the specs are listed here on this slide. 30-year fixed interest rates have jumped up a bit. They're around 3%. 15-year fixed interest rates are 2.5%. Asset prices still at all-time highs. What I mean by that is stocks and home values. Those are what I mean by asset. All at all-time highs, as high as they've been ever. Unemployment came out earlier in March. It's around 6.2%. And what really has been driving this increase in interest rates over the last, I would say, 60 days is the perception that the economy is going to get better, is the perception that coronavirus is starting to go away a bit. Vaccines are becoming more prevalent. Cities, counties, states are opening up. And as economies and cities and states start to do better, people want to put their money more into equities. And that's the opposite of what bonds are. Bonds and mortgage, bonds are essentially mortgages or bonds, and get invested in when people are spooked and scared of economies. So anytime people take their money out of bonds and put them into equities, you start to see interest rates on mortgages go up. And that's what's been happening in the last 60 days or so. Jerome Powell is our head of the Federal Reserve. He spoke earlier this week, and he also said that he's not going to raise interest rates anytime soon, which means that we should see these relatively low interest rates for the foreseeable future. Not 2.5% though, closer to, I think, the 3 to 3.5% range for the 30-year fix. Still offering buyers a lot of purchase power though, and something that's good for us when we're representing buyers, especially as the agents and the lenders. Questions there, Deb, at all? Okay. Okay, goal of this presentation, I touched on it a little bit in the beginning, but it's really to understand the loan to value ratio, the effects of a low appraisal, and then be able to explain them to your client. I also put somewhere in here right below for someone to ask me about seller credits at the end of the presentation. It's not in this slide, but it's something that is potentially pertinent to the overall presentation. I didn't have time, and I won't have time to actually touch on the slide, but if you guys have some questions, or if you want me to quickly touch on seller credits, please remind me. Okay, the loan to value ratio. It's what it sounds like. It's the loan divided by the value of the house.
Alex, before you get going with that, I did have a question that just came up. Mona's asking, Jerome Powell is the one in charge of controlling the interest rates. Question, is that correct?
He controls what's called the federal funds rate, which is the rate that banks in the US can lend money to each other back and forth at. He doesn't control mortgage rates. Mortgage rates are controlled by the banks who set them, but they look to Jerome Powell for guidance. So you could say that he quasi controls interest rates, but he does not control mortgage interest rates. He controls federal funds rate. Do a little bit of digging on the federal funds rate and you will see what that is. Okay, cool. So loan to value ratio, getting back to this, loan divided by the value of the house. Right there, I just have a quick example. 80% means someone got an $800,000 loan on a $1 million house. Okay, seems pretty simple, but sometimes it gets a little confusing at some point when we're dealing with different values versus different purchase prices. Okay, the little sentence I have below that with the stars, important. Loan to value ratio is always based on the lower of the appraised value or the purchase price. Okay. So again, I'll say it again because it's really important. Loan to value ratio is based on the lower of the appraised value or the purchase price. One thing people think is that if they get a higher appraisal, then all of a sudden they can get a higher loan. But if you got into contract at a lower price, that's what the bank is going to use. They're not going to use the higher appraisal. It's based on the lower of the two. Okay, super important to remember. Example of a higher appraised value. Let's say that we have $1 million purchase price, but the appraisal came in at $1,050,000. Our loan amount is 800 grand. Does anyone want to type in what our loan to value ratio is? I can't really see if anyone did or not, but I'll give another 20 seconds.
Is it 80%?
Thank you, Ace. 80%. Okay. It's not 800 grand divided by $1,050,000, even though that's what the appraisal came in at. The one thing that you have in your back pocket there with your client is, hey, client, I did such a good job. I just got you into contract at $1 million and your appraisal came in at $1,050,000. So pat me on the back. But as far as the loan is concerned, they do not get to take advantage of the extra 50 grand that the appraisal came in at. It's just something to make them feel like they got a sweeter deal than you know, the other way around. Okay. So there's a bunch of different loans in the market of loans. One being FHA loans, and we've done presentations on these. VA loans, rural loans, we don't do a lot of, that's USDA. Conforming conventional, high balance conforming, and jumbo loans. These all have different maximum loan to value ratios that they do. Each one has a specific max. FHA, for instance, will allow your loan amount to be 96.5% of the value of your house. VA and rural loans, the USDA, will allow you to finance up to 100% of the value of the house. The conforming loans, which is the, you know, the Fannie Mae, Freddie Mac loans all across the United States, will allow you to finance up to 97% of the purchase price of the house, up to a $548,000 loan amount. Okay. So said differently, just to do some quick math for you guys, the max purchase price with 3% down on a conventional loan is right around $564,000. So a client could buy a house for $564,000 with 3% down and get a conventional loan. In LA County, in Orange County, in San Mateo County, and all of the counties where purchase prices are through the roof, they allow us to do this additional conforming loan called a high balance loan. This is important for us in LA County because this means that someone can put 5% down and get a loan amount of $822,000. So said differently, that means someone can buy an $865,000 house in LA or Orange County with 5% down. They could also use an FHA loan at that amount and put 3.5% down. But if they wanted a conventional loan, which are ultimately better loans for your clients, they would need to come up with 5% if they fall into that 548 to 822 spread of loan amounts. Lastly, the final loan that's in the market is called the jumbo loan. And that's when your loan amount exceeds the 822 in LA, Orange County. Those banks like to have at least 20% down. Deb, is there any questions on this slide? Okay, good, good. This is important to remember. Okay, this is very important to remember what type of loan your client is doing, because the lower than 20% down will come into play should you experience a low appraised value. And here we go, dealing with low appraisals. So we have a purchase price of $1 million. We're going to just use this same example, but our appraisal comes in at 950. The loan amount is 800. What is the loan to value ratio the bank is using?
Is a high balance?
Say it again, Ace.
The high balance?
We fall in the high balance category of loans, yes. But what is the actual numerical number that will be associated with this transaction for the loan to value ratio?
Mona is saying 950. I'm not
No, it's okay. It uses the 950 amount, but when we do a loan to value, what two numbers are we using?
Is it still 20% or 80%?
Nope. Remember, the bank uses the lesser of the purchase price or the appraised value.
81%, 85, 84.
84.2. Very good.
Yes.
good for you.
Okay, so then the way that she got that number is she takes 800 divided by 950. We're still buying the house for $1 million because that's what you agreed to pay at the beginning. But now the bank thinks that your loan is much riskier than it would be if the appraisal came at $1 million, because you now only have a spread of roughly 16% between the loan and the appraised value. This matters for a number of reasons. The main reason is that this would now involve some additional assurance to the bank that the client is good to go, and that comes in the form of mortgage insurance. So a number of things happen typically in this scenario. Mainly what people think has to happen is the client has to bring in an extra $50,000 to make the scenario work. And that's not true, just right off the bat. This loan, if the appraisal comes in low, still gets done as long as the client qualifies. The bank will do an $800,000 loan in LA County on a $950,000 appraised value, because as Ace pointed out, it falls in that high balance conforming loan limit, and the banks will actually go up to 95%. So 84.2 is less than 95. This client is essentially just putting down 16% according to the bank, but has to put down 20% to keep your deal as you originally inked it.
So in other words, they're having to make up the difference between the appraisal and the agreed purchase price?
No.
No. I'm sorry.
It's okay. It's the exact question I wanted you to ask, because it is the assumed solution, and it's not true.
And we have a question, if I can roll a little longer.
Yeah.
Mona's asking, she said right now clients are waiving appraisals. So
Correct.
let's say a home's worth 500,000 and the purchase price is 600,000, which I think is right along where we're looking here. At what price are they getting a loan for? How are they doing this? I think this is all what you're trying to explain here, correct?
100%. Yep. Thank you, Mona. Great question. The bank, as the bank sees that loan that Mona just presented, they see the value of the house as 500. They do not see the value of the house as 600. even though your client is having to pay 600 for that house. So going back to our slide that we were previously looking at, $500,000 is if they're doing a conventional loan right here, the client only has to put 3% down on that. So as long as the client's loan amount is, sorry, let me just have exacts, 485, the bank will give them that loan. It will come with a lot of additional mortgage insurance, but essentially what the client has to do is they have to put down $115,000, even though the house only appraised for 500 and the bank is assuming they're only putting $15,000 down. Does that make sense, Deb? Did I explain that okay? You're muted.
One more time.
Okay. The loan to value ratio is always based off of the lesser of the appraised value or the purchase price. Lesser of. In Mona's example, the purchase price is $600,000. But in Mona's example, the appraisal is $500,000. So the client's max loan amount in that situation is $485,000 because that is 97% of the appraised value. Okay. In this situation, because the client waived the appraisal and they're paying $600,000 for the house, they have to come up with $115,000. But the bank is assuming the risk of that the client presents as really high and that they're only putting 3% down, not, 115,000. Confusing, I know, but I hope that helps.
Alex, to clarify, meaning they have to put 100,000 to cover that 100 for 500 to 600. That they have to put 100 to cover that difference, plus the extra 15,000, which is the 3% on top of that.
Correct.
Okay.
Correct. Yep. But it's not always a 1-for-1. They don't always have to put in the difference between the appraisal and the purchase price. This person just did because they are trying to achieve max financing. But I'll show you later in the slides how I'll show you later where that doesn't necessarily apply, where they have to put in the full difference. The most important things to understand by these examples are, again, the lesser of the appraised value or the purchase price. Okay. And going back to this slide, our loan to value ratio here we discovered is 84.2%. The client in this situation doesn't need to come up with any additional money at all, because 84.2% is a lendable loan to value ratio. In this case, the client would have to pay an additional small monthly amount because they present more risk to the bank. But to answer Deb's question, they do not have to come in with $50,000. Okay. They now just would have to pay mortgage insurance because they exceed the 80% loan to value ratio that is required to not have mortgage insurance. Any questions?
Yes. Mona's asking if these conforming conventional loans only require 3% down, why doesn't everyone use this instead of traditional conventional loan?
They're the same loan, conventional, they're the same loan, but people want to put more down to have lower payments. And it's hard to get offers accepted with 3% down right now. And when you put 3% down, you have an additional monthly amount that's attached to your mortgage payment that you pay to a private mortgage company, private mortgage insurance company, excuse me, to help offset the risk that you present to the bank. You don't have that much equity, so the bank has to have the reassurance that you will pay your mortgage payment. And if you don't, mortgage insurance will help cover the fact that you didn't. So most people, I mean, it's a really great question, Mona, and it's just most people are under the misconception that they have to put down 20%. And that's something that as real estate agents, you guys need to convey time and time again and to upend that misconception. But as a seller, as a listing agent, you guys are under the impression that a loan or an offer with 20 to 30 to 40 to 50% down will get done easier than an offer with only 3% down, which isn't true. I can do the 3% down loan just as easy as I can do the 20, 30, 40% down loan. The 3% down presents you a little bit more risk because if the appraisal doesn't come in exactly at what the client offered for the purchase, we have this issue that this slide is presenting. We now have someone trying to achieve financing on a house that may appraise right for the loan amount and right at the loan amount, and that won't work on a conventional loan. So putting more down, it affords you the ability to problem solve a little bit easier. But I agree with Mona in that if you can put less down and use the money to fix the house or do something else with it, you're way better off because the interest rates are still only 3 to 3.25%. It's pretty cheap money. Go ahead, Deb.
Okay, I have 2 more points, maybe 3. Okay, Heidi is asking, does the cost of mortgage insurance vary?
Yes. You
So-
present more risk to the
Yeah.
bank. Let me just answer this one first. It's all done in 5% increments. So 80 to 85% is an increment. 85 to 90 is another increment. 90 to 95 is another increment. 95 to 97 is an even additional increment. We have 4 increments. The cost of mortgage insurance rises as you go from each increment up, right? For instance, if you fall between 80 and 85%, your mortgage insurance is $30. If you fall between 85 to 90, maybe it's $60. If you fall between 90 to 95, potentially it's $120. And then between 90 to 95 to 97, now it's $250. Those numbers differ for each client because it's based on their credit score. It's based on a number of other factors just besides how much you're putting down. But that's one of the reasons, to go back to Mona's question, why people put down more, because they then have lower amounts associated with the mortgage insurance.
So kind of bottom line, the more you borrow, the higher that PMI will be.
Exactly.
Okay. Another question from Mona. She's asking about the PMI. She said that someone has said that once you have 20% equity in a home, they no longer pay PMI. Is that true? And do they need to refinance in order to get that?
Okay. We're going to touch really quickly on it. Mona, you can call me afterwards on this because this is a completely different slide and series of slides. Basically, mortgage insurance is paid until you get to 22% equity, and that's when it automatically goes away. When you have 20% equity, then you can petition the bank to make it go away. You do not have to refinance. But if you only have 20%, or if you feel like you have 20%, you actually have to reach out to them and ask them to remove it. But it would automatically go away when you get to 78%, or said conversely, you have 22% equity in the house.
I think that's good for now. We can move on. Thank you.
You're welcome. You're welcome. So going back to the slide that's on up right now, why does this matter? It matters because we have to restructure the loan a little bit. We either have to do mortgage insurance or you have to go back and renegotiate. If you don't want to renegotiate because you're in a seller's market and they're not going to renegotiate with you, the client can still get the loan. They just have to use mortgage insurance. Okay. What does this change as far as the loan is concerned? That's it. It now incorporates mortgage insurance because the client is riskier. Next slide. Here's a slide that I want to put in because it's really important for every one of you to understand why people have this misconception, because it is a misconception, but it's not necessarily a bad one. More down payment is nicer to have. It eliminates some risk, but it's not absolutely necessary. The reason it's nice is because it obviously means less risk to the bank, so the client gets a better rate, the client gets a better deal. It means less risk for a lower appraisal. We don't always have to recalibrate the loan. If someone's putting 40% down and the appraisal comes in low, that just means that the bank sees it as 35% down instead of 40. The loan that you do at 35 and 40% down is exactly the same, right? So that's why big down payments are nice and are seen as more attractive when you're listing a house. A client with more down payment is assumed to be in a better financial position. You're a listing agent, you're seeing this big down payment, you're seeing this big checking account with 300 grand in it, and you're like, I'm going to accept this offer. You don't have to do that. If the client's writing the offer with 5% down, they're bringing in a lot more purchase price, it might be worth it, because again, I can get those deals done just as easily as long as the client qualifies. So make sure, even on the listing side, that you guys know these types of ratios and you know how to explain this, because you can get your seller potentially more money, even though the client is putting down a little bit less money that are writing an offer on that house. It's an important thing to know. Okay. Is more down payment necessary? It's not. I've touched on that a bunch, but again, we can get the loans done with 5% down just as easy as 20. We can restructure the deals if the appraisals come in low. I'm going to give you 2 examples here in a second. The one time where we get really upended is when the client is trying to achieve the max financing, when they're going to the 96.5% on FHA, or the 97% on conventional, or 95% on the high balance conforming conventional loans. Okay, that's when they do have to bring some more money to the table. That's when, you have to potentially renegotiate with the seller. And I'll show you these slides real quick. 2 examples. Okay. Here's one that's similar to the previous one. So purchase price $750. Client is putting 10% down, $75,000. Our loan amount is $675. Client right now with this loan will have $150 of mortgage insurance. Okay. Boom. They do the appraisal. All of a sudden it comes in at $725. Deb, does the client need to make up the difference?
Let's ask the others. No.
Ace, does the client need to make up the difference? Does the client, do you tell your client, oh, you're hosed, you have to bring in $25,000?
No, they don't.
No. Thank you. Good. Why not?
They don't, but they have to pay a PMI or
they're
yes.
already paying PMI. What potentially is going to happen to the PMI because the lower appraisal?
It'd just be higher.
Perfect. So now 675 on 725, which is your new loan to value ratio, is 93%. This still works. Okay. The client just has to pay 30 more bucks a month. And this is something that you guys as agents, people are going to get really freaked out when appraisals come in low. And you need to be able to mitigate that by talking to the lender who's representing them and understanding that the loan to value ratio will still work, and it's going to mean 30 more bucks for the client. That, people can swallow that pill pretty easily. Okay.
So Alex, I think, I know when I have had transactions, and that's always a concern, is that appraisal not coming in and the buyer's going to have to make up the difference, whatever that might be, that gap. that's not always the case. Is that what you're sharing here?
Yep.
Not always the case. You go back to the lender and you find out if in fact they were maxed on their loan to value ratios.
Yes.
And if they weren't maxed on their loan to value ratios, there is that opportunity that they could still do the loan.
Just with a slight restructure of it.
Got it.
Okay. And it's not huge numerically. It's usually pretty minimal. If your client is putting down, in this example, 10%, and then all of a sudden the appraisal comes in low and it looks like they're, you know, per the bank, they're only putting down 7, they just have a little bit more mortgage insurance per month. And then you don't have to worry about renegotiating. You just have to tell the buyer that this is the market they're in. And this is, if you didn't, you know, offer 750 on this house, you wouldn't have gotten this house. And you just have to be confident in the neighborhood and the market and the, you know, those types of things really freak buyers out. And if you guys are freaked out by it too, everyone's going to stay freaked out. But if you can use this example to say, we can restructure this a little bit and it's not going to make a huge difference to your monthly payment, let's just talk to your lender and figure that out, then it's going to make everyone's sleep a lot easier.
And I think I heard you mention earlier too, that it also is going to be based on their credit scores and their debt to income ratio. Is that correct?
Yes.
To the restructure ability.
Correct. It is. So
we want to quickly circle, once we find out there's a low appraisal, quickly circle back to the lender, let the lender get to work and see if he can make it work.
First, exactly. Before you start throwing out numbers, you need to talk to the lender, because if someone's credit score is 680, the amount of mortgage insurance they would have to pay in this scenario, the increase in mortgage insurance they would have to pay in this scenario is different than if the credit score is 740. So definitely well said right there, Deb. Before you start throwing numbers out to your clients and say, it's just going to be $30 more a month, make sure you talk to the lender to figure out where this client's credit file, credit lies. You probably are submitting the offer with a, at least a first page of the credit report, so but just remember, mortgage insurance is a product of the loan to value and the client's credit. So just because the appraisal came in low and you now have a slightly higher loan to value, you need to definitely make sure where the credit report is to see what the increase would be. But it's still not a deal killer at all.
And I just want to emphasize that, because I know we typically we have a lot of new agents that are listening, and we want to make certain that, one, you're not giving information that you're not 100% certain on. Alex, the expert when it comes to loans, so you always want to refer them back to Alex. You're going to be the expert when it comes to the real estate end of it, the negotiating, etc. So just get in the habit of, working closely with your support team and the experts that you're, pairing yourself with, so that they can take over and take care when you run into these situations. It's not your responsibility to resolve an appraisal that didn't come in.
100%. It will help if you know that this is just possible. And that's what I want the takeaway to be from this whole presentation, is that low appraisals do not typically completely upend deals, that we have other ways as a lender to make them work. And you guys are the psychologists in the dealing with the emotions of the buyers and knowing that this is that we're capable of doing this. Notwithstanding just the specific numbers, you don't need to worry about the specific numbers, but knowing that we're capable of doing this is ever important to be able to manage those emotions of those buyers. Awesome. Okay, next example is an FHA example. This happens a lot. FHA and VA loans are considered government loans. Government loans, because they typically are being done with very little down payment, have the tendency to have more appraisal issues. Okay, the bank is more concerned about them because they don't have equity in them. They're typically clients with less financial stature in terms of credit scores and down payment and reserve assets and income, etc. So in this example, you have a purchase price of 650. The client is putting 3.5% down, which is the minimum FHA. Your loan amount is 627,250. Okay. The appraisal comes in at 640. Now, if you're doing an FHA loan, the max loan amount here is 617,600, which is 96.5% of 640. I take my 640 loan amount, I multiply it by 96 by 0.965, and that's how I get this 617 number. One thing I want to present, I just clicked the slide a little too early, I'm sorry, but just because this thing came in 10 grand low, this client doesn't exactly need to bring in 10 grand extra. They do need to come up with extra money in this case. And this is a case of a client trying to achieve max financing. What they have to come up with is just $9,650. And that is the difference between the original loan amount we were trying to do and the new loan amount we're able to do. So I want to run this by you guys. Let's say that this is your scenario and the seller is not going to renegotiate. Initially, the client is coming up with a down payment of $22,500. That number is the difference between 650 and 627,250 up here in the top. Can you see my cursor? Hopefully. Now, what does the client, what does the client have to, what's the total amount of down payment that the client has to do here if the seller will not renegotiate? Does anyone know?
32,400.
Bingo. Awesome job, Ace. 32,400 exactly. Okay.
Good job, Ace.
Thank you. Thank you. So in this case, the big thing I wanted to just point out here again is how ratios work. And it's not a straight $10,000 extra amount that this client needs to come up with. It's just slightly less. Okay. So the new loan max is based on the lesser of the appraisal or the purchase price. In this case, in this example, it's the appraisal. The appraisal came in low at 640. So we now can do a max loan of 617,600. As Ace pointed out, and we're not dealing with an amicable seller here. So we now have to instruct the client, they got to come up with a total of $32,400 instead of $22,500. Okay. They can get the money from mom and dad. They can get the money from a 401k. They can try to find the money. But there's no restructuring of this deal. What you will find typically in these deals is that this is a house that didn't have 15 offers on it, and the sellers are typically willing to potentially work with you. So again, nothing is completely thrown out as hosed here. We can work with the seller and we can try to make this deal work. We can come to the close, and let's say they will meet you in the middle and you get a purchase price of 645. Okay. That helps the client as well. That drops the amount of money the client needs to bring to the table. And that's what, in my experience, you will find will happen with these FHA and VA deals, the government style loans. Any questions there, Deb?
None at this point.
Okay, cool. One thing I wanted to touch on, I think this is potentially the last slide here. Hold on. Yep. Okay. In this instance, I wanted to go back and talk about the seller credit, because you can't structure this FHA deal with with seller credit to try to make up the difference, to try to keep the purchase price. But then, you know, what you're able to use seller credit for is only closing costs. You cannot use seller credit to help cover the difference of a low appraisal. In this case, as Ace pointed out, keeping everything kind of equal in this FHA example, the client has to bring in $32,400 for the down payment. That isn't the total amount that they would need to bring in. They have closing costs on top of that to make the deal work, to the tune of, call it $10,000. So if you wanted to keep the purchase price the same, because a lot of people like to keep the purchase price the same, but then you want to ask the seller for a seller credit, they can help credit the client for the closing costs to reduce the amount that they would have to bring to close on top of that $32,400. That is another example of how we see these deals potentially work. Because why is that? Because this client now would have to bring to close almost $10,000 more dollars. But if you can have a seller help you with those closing costs, you may be able to just talk the client into bringing in the $10,000 extra dollars that it would take to make the LTV work. I hope that makes sense. Any response there?
No, no questions, just no.
Okay, well, that's all I got for the day. That is loan to value ratios, low appraisals. Each scenario is different. Even if I'm not the lender in your scenario, you can always feel free to call me, email me on this phone that's listed here on the slide, that email that's listed on the slide. You can walk into the Coastal Properties office. I'm sitting right in the front. If my door is closed, just knock on the window. I will gladly help you, walk you through these scenarios. Again, each one is always different. Each client's financial picture is always different. That's what makes loans so hard. That's what makes our job so hard. But it is, you know, the best job out there. So keep at it, please, you guys. I know you're new, but feel free to never hesitate to ask me any questions about anything, from mortgage insurance, loan to value ratios, down payment, all of that. I'm here for you.
If Alex, if no one have any question, can you go over the seller credits?
Okay.
Yeah, what part of it?
You asked us to remind you if you
Oh,
have questions
yeah.
on seller credits.
Yeah, I kind of just
Thanks,
I
Ace.
just touched on it right before that about the FHA thing. But seller credits are, let's say that you had a request for repairs, right? You all of a sudden you did a inspection and the house needs some repairs, but the seller doesn't want to do it and just wants to give your buyer money instead. Seller credits can only cover closing costs. Very important. There's two types of closing costs: recurring and non-recurring. Recurring closing costs are things that will happen over and over and over again for your client: property taxes, interest, impound accounts. Non-recurring closing costs are things like escrow and title fees, appraisal fees, notary fees, recording fees, things that are only one-time fees. Non-recurring is one time, recurring is over and over and over again. Closing cost credit, seller credit, can cover both types, okay? But it cannot exceed the total amount. So if your closing costs are $10,000, but your seller is trying to give you $12,000 of credit, that will not work. We have to then figure out how to either make more closing costs, which you can do by lowering the interest rate or paying extra HOA fees for future months, or you know, usually those are the two ways, to be honest. Or you can't capitalize on all the seller credit. So the one thing again to remember is if you're after $20,000 of seller credit, there has to be $20,000 of closing costs. The client must bring in their down payment. The seller cannot contribute to the client's down payment. And if the credit exceeds the cost, that's essentially what they would be doing. I'm going to say that again because it's very important. The client's closing costs, seller credit cannot exceed the closing costs on the loan. If it did, the client's seller credit would be attributing to some of the down payment, and that's not allowed. So you have to make more costs to capitalize on additional seller credit if it exceeds the initial closing costs. Okay, that's the thing I wanted to touch on. You're muted, Deb. You're muted.
Okay. Can your next class please be about credit repair and financing and grants for people with low credit scores?
It's a good request. Credit repair and
financing and grants for people with low credit scores. Is that something you just can explain a little bit about now that we have?
Yeah, I mean, my job is definitely not credit repair. I have a client, or I have a referral source that does credit repair. I can touch on some things about credit repair, but it's definitely not something that I have time to help fix everybody's credit. I can give a client a baseline idea of what they can potentially do to repair their credit. And mainly it's just reducing the credit card balances compared to the limits on credit cards that they have. But if you would reach out to my email that's on this slide, I can give you a resource that will offer you some services for credit repair that you can then forward on.
Yeah, because that's a whole nother class.
It's a whole nother class.
By a whole nother person.
It's a whole nother person that actually came to Keller Williams and taught a class on it.
Yes.
Back when that was the thing.
Yep.
So we can share those slides. We can definitely do one of these with that company. They love to do Zoom, and they will do Zoom for you guys. Okay. And I'm happy to set that up and get Deb to put that on the calendar. I just don't teach that class. And it's not my area of expertise.
I have two other comments here still. Melanie, I think it is Melanie, is asking why. This is referencing back to what we were talking to, the seller credits. Why is that not allowed if the sellers are willing to provide the credit? So I think she's referring to why can't it go towards maybe the earnest money or the down payment? I'm thinking Melanie, yes, thumbs up.
Yeah, no, it's a great question. And it's purely because the seller, it's considered a concession right there. That's essentially the seller is giving your client money for the down payment, and that's too intertwined. That then turns this into a non-arm's length transaction. So the seller cannot contribute to the client's down payment. If they give the client money above and beyond what their closing costs are, that's how it's deemed to the bank. So it's just not allowed. There's no real good explanation besides they cannot contribute to the down payment for your client. If the seller is willing to give them the money, we have to create additional costs, or you could potentially reduce the purchase price. But there's no way to get $20,000 seller credit when the closing costs are only $10,000 for the client. Just commit that to memory.
There's one, I have a comment that I'll share in a moment, but I've always, that made me laugh. Anyways, I've always been told that most lenders do not want to see price reductions because it can delay the loan process. Is that accurate?
It just depends on where you're at in the loan process.
Okay.
If you get an appraisal in the first 10 days and it comes in low, and then you guys go back and negotiate in the next 5 days and we're only 15 days in, then that's fine. if you're trying to negotiate a change in the purchase price and we're at day 27 of day 30, then yeah, that definitely changes things. We have to rerun and redo a lot of the processes if the appraisal or if the purchase price reduces. So yes and no. It just, much like anything, and much like what you tell these guys, Deb, is that everything needs to be done kind of as quickly as possible, because there's so many people that have to do their job well to make these things close. Okay. And if you guys are trying to renegotiate price at day 25, we're probably going to see a delay. Sure. But if it's at day 15, no, we won't.
Yeah, you always want to be proactive. You know, we don't want to sit back and wait for someone else to do the job that you could actually be doing to keep things moving forward and, you know, stay on top of it. So we've had comments of thank you, great class. I just want to make sure we share that with you. And then, of course, our wonderful Edward Knighton is asking, is it difficult to be an Orange County lifeguard?
Thank you, Ed. He always is there for me.
Yeah, exactly. Anyway, anybody?
Yes, it was a great job. I'm no longer an Orange County lifeguard, but Ed did, back in my heyday, I was an Orange County Newport Beach lifeguard, and it was not difficult. No, it was the best job ever. Benny the Lender is much more difficult.
Yeah, right. And you did it for a long time, right?
Yeah, 20 years.
Wow. He's only 20 years old too.
It was crazy. I was saving him as a baby.
All right. Anybody else have questions?
They did ask about grant money. Grant money is not a loan that I typically do either. If I'm you, I know that you guys are new and that's potentially your client base, but it really is it's not a client you should be overly seeking, right? If it is a client that you come across, there are potential options out there. The credit unions in Long Beach do some of them. I can refer them to some people that do them. It's more for, like, Bank of America has a pretty good one. Who else? There's the grants are, there's some grants for your public service style people right now. And I can steer those people in the right direction, but it's not a loan that after COVID I have access to anymore, unfortunately. I honestly, Deb, I think the guy from up in LA, Jojo, I'm pretty sure Jojo has some access to some grant money programs. I know he was mentioning that at the last team meeting. And if there is a desire for a class, I'm sure he would be more than willing to jump all over that and teach it.
Cool. Thanks. We'll definitely keep that in mind.
Yeah.
I'm not seeing any other questions. So if no one else has any questions, let me just see. Nothing. Alex, thank you ever so much. I know all the agents are appreciating your information and guidance. We're grateful to have you here as part of our Long Beach Coastal team. And agents, please, please, please remember to reach out. He's your first go-to. So know that you're going with someone who is solid and experienced, because when you're not, things get really messy. And I'm sure you can have that conversation with just about any agent who's had a situation that did not go down the road they wanted to, cause delays and, a lot of stuff that you don't want to happen. So make sure you're pairing yourself with the right people.
Thank you, Deb. Thank you, everybody.
All right. Take care.
Bye-bye.
Bye.